Hi, everyone. Larry Berman here, and I bet you can guess what's on my radar and everyone else's this week. When we look at the dramatic moves in a couple of places, obviously Silicon Valley Bank is at the top of the list of what we have to think about this week. So let's dive right into the chart room and see what we can see. First chart we're looking at here is the U.S. two-year interest rate. And as all will know, over the last year plus, the inflation scare, reality, change in dynamic, however you want to phrase it, is the most dramatic uptick in a short period of time that we've seen, well, basically since the early 1980s. And we've had other moves of interest rates rising. They've been far more gradual. So it's not too surprising that the shock is coming. And I think that Wall Street's been benign to this notion for quite a while. Because it's not happened. Anybody investing today hasn't ever seen this in real time. So we can go back and study the charts, but if I blow this up here and look at it closely, since Wednesday's close, see here at 507, US 2-year went out today at 458, but a 49 basis point move in the 2-year. Now, if you look back over history and we say, well, when has that happened before? There's a couple dates here we want to look at. So I've got some notes here I'm going to look at because someone had sent me something earlier in the day. So thanks, Andy, for sending this along. 4 other times in the last 40 years, October 20th, 1987, obviously the day after the 1987 stock market crash. September 14th, 2001, a couple days after 9/11. September 15th, 2008, the day Lehman failed. And then September 29, 2008, 2 days after they failed initial vote on the Troubled Asset Relief Program, the TARP program. So I think the question we have to ask today is this like that? And the answer is I don't think we know. But definitely the market isn't ready for a shock. And to see what was, I was told, I haven't vetted the data, the 15th largest bank in the US basically implode in 48 hours is mind-numbing. So, here's a bank that when we filter it fundamentally, we like the earnings, we like a lot about it. Again, 15th largest bank in the world. So, how do we hated it up here. We thought the speculation around Silicon Valley and everything was ridiculous. Absolutely hated up there. We never shorted the bank, but this became a proxy for a short against technology for a lot of players, a lot of hedge funds. And we've been following it for a little while. We have not dabbled in it until very recently. So we've been following it. And what we did on September 2nd, so the day after the Fed meeting, the markets popped. We got up to the 200-day and started to roll over. So on this day, I looked at it and I analyzed it and I said, boy, if we get back to those lows or even lower, and I could buy this thing at half of what I sold it for, or bought what's that, at 340, approximately where we bought it, at 170, to me, that was a good trade. So what did I do on February 2nd? I bought a 210 put, which takes us to this support area here. And I sold the ratio put spreads that I like to talk about. I sold 2 190 puts. And the thinking here is my break even is 170. And if I can buy this thing at half price, I like it. Never in a million years did I contemplate what's going on today. So here's a question, folks, of being right on a market call and actually not only making no money, losing a ton of money. Because what happened is our break even's 170. Now I'm long the stock net at 170, and this might resolve at zero, given that the FDIC has closed the door on the bank and they're for sale. What the equity holders end up getting, I don't know at this point. This is also speaks to the benefit of diversifying and not making huge bets. And so this was a 1% bet for me, which basically means that it's going to impact my NAV by 1% in my equity fund and in my yield fund. So what does that mean? So it doesn't actually mean a lot, because this year I've been outperforming quite a bit. And so it takes away from that. Am I happy about it? Absolutely not. But it kind of underscores, kind of what's happening today. So the knock-on effect here is pretty material. And so let's look at the regional banks, the broader, smaller banks in the US that isn't Citibank and Bank of America and JP Morgan and the big city center banks, but the regional banks. And KRE is the ETF that tracks that. Silicon Valley Bank and some of the other names that have been in the news of late are certainly in this ETF. And I've taken the ETF back to when it started in 2006. Obviously, regional banking index goes back way before that. But here, in case of the ETF, and to me, I'm looking, well, where's the value here? Obviously, COVID was the shock. Once we got the vaccine, this thing gapped above 40, rapidly advancing as things recovered in 2020. So, to me, there's the October gap. 45 was that gap. If we go back and look at the pre-COVID lows after the sell-off in 2018 on the tightening there, 45. We go back and look at where did this stock get to after we got the recovery after the GFC, and we see that it started to run into resistance around low 40s, mid 40s. So to me, low to mid 40s is actually pretty attractive. So this is where I'm looking to get back into the regional banks. And so we're not at the point where we talk about the bull and bear call of the week yet, because I got a few other things to look at first. But, from the bull side, these distressed assets in the sector are starting to be where I'm kind of looking at here. So that will be our bull pick of the week. And how do you play this? Well, again, let's look at the option market and say, okay, between now and the seasonal weakness that we would get, let's say by September, we would look at where a 40 put is traded. It's not even on the board yet, so let's call it a 45 put. So about 10% below here. You're going to pick up a premium, say last trade at $2.79, $2.80. So approximately, a good, 6% ish there on 50 off 45, about 6%. So, picking up a pretty good yield here to write a put and buy it in a level that probably represents some long-term value. So regional banks in the US under this distressed situation starting to look very, very interesting. In the last few weeks, look, I've been writing puts to buy these things, at their, 2022 lows or lower. And so I like that exposure here a lot. When we look at the index to today and what's inside of it, 143 stocks in it, 22 are actually up, 120 were down. Anything that smells like California, so Pac West Bank, Signature Bank, that's New York, Western Alliance Bank, anything that's even remotely linked to Silicon Valley is of issue. Silvergate here, is the one that linked to the crypto, and so forth. So, you've got a lot of these regional banks under significant distress. Some of them, maybe some beneficiaries there, better run, cleaner balance sheets. Who's going to take this out? I think it's probably a going concern, but I want to see where the dust settles maybe over the weekend here, in terms of what ends up happening. I'm by no means an expert on Silicon Valley Bank, but based on what I've read so far and what some of the analysts say, it's idiosyncratic, it's not systemic. So I don't think this leads to a meltdown, like the great financial crisis. Are there credit risks? Absolutely. Will there be some loan losses in some of the banks? Absolutely. Does this change that technology is the future and more investment in technology in the years to come? Absolutely not. Good, well-run companies should do very well. But anybody who's massively leveraged here with the higher for longer narrative out there. So did that 2-year coming down so hard this year or this week, the last 2 days, tell us that the Fed is going to be forced into a pivot? What does that mean for inflation? There's a lot of things here that are adding to the uncertainty, not the least of which was yet another strong employment report. And while some of the makeup of that was a little bit more friendly, in terms of hourly earnings came off a little bit, hours worked was down. So this kind of says the labor force is weakening a little bit. Participation went up, more people looking for jobs. So what did that mean? Unemployment rate ticked up. But generally speaking, it's making the Fed's job really, really hard. I think 50 basis points was never on the table, but the fact that Powell mentioned that this week, very, very interesting there. So when we look at some of the weaker, more leveraged plays in the market, we look naturally at our ARK-K ETF, and Kathy's been and her team's been busy buying up Tesla on the weakness. I'm short Tesla here. I think again under 100. I think it's a stock I want to own, but not at these levels, not at these multiples. With what's going on, Kathy's got a very, very, very different time frame than I do. Now, I wrote some puts today on CRISPR Therapeutics, Invitae, are names that I think are interesting plays from the technology standpoint. I love the biotech and therapeutics and what's going on with genome therapies and everything else related to that. So there's a couple names in her portfolio that I like at these levels. I think on CRISPR, we're writing puts at 35, and I think on Invitae, we're at 150. So that's already in the money now today, on those. Teladoc's another name that we like in the portfolio that I got no position. Well, I got some small position on right now, but I'm looking to build that up towards 1% in the portfolio. We're not there yet. We're about 0.5%. So into weakness, there's another name, some pretty good premiums, on that. So there's a lot of opportunity in the volatility here. And, for the bull and bear picks of the week, we talked about that. On the bear side, what did I do this week? This is kind of another bull and bear trade, but a couple of days ago, we bought ratio put spreads on small caps. So why did we do that? Well, we thought that small caps were unusually strong given our economic scenario for a harder landing. Where would this go down to in a harder landing scenario? We would almost certainly take out the lows that we made last year. And again, going back and looking at the charts, and so where's the value here? Didn't think we'd get down to any of these levels here, and I don't think the downturn in the economy would be like that. But in the 140 area for IWM, it starts to get very interesting. So we bought 150, 140 put spreads, and those 150s now are making us some money. And in the next few weeks or months, we'll look to take a profit on that long put and expose the downside to adding 10% exposure to US small caps around 140 on the IWM. So bit of a bear and a bull, but a lot of opportunity coming up here, folks. Keep some powder dry, learn how to use some optionality to help you. But even when you're right, like I was on the correction on Silicon Valley, I was still wrong. Have a great week, everyone.